financial institutions will come to order. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearings. With the hybrid format of this hearing, we have some members and witnesses participating in person and others on the WebEx platform. I'd like to remind all members participating remotely to keep themselves muted when they are not being recognized. The staff has been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you are participating remotely today, please keep your camera on, and if you choose to attend a different remote proceeding, please turn your camera off. This hearing is entitled Addressing Climate as a Systemic Risk, the Need to Build Resilience Within Our Banking and Financial System. I now recognize myself for 4 minutes to give an opening statement. In 2008, the housing bubble collapse and financial crisis caught many experts, investors, and policymakers off guard, and the resulting Great Recession devastated communities across the country. When threats to financial stability are not properly valued and mitigated, the consequences can be severe and long-standing. 2020 tied 2016 as the hottest year on record, and the 7 hottest years recorded have all occurred since 2014. In 2020 alone, more than 58,000 wildfires burned 10.1 million acres and caused $20 billion in damages. In my home state of Colorado, in addition to more severe and frequent wildfires, we're seeing less annual snowpack, more water scarcity and droughts, and more heat waves. These changes pose long-term risks for Colorado's agriculture, tourism, and housing industry. Whether it is rising sea levels threatening coastal communities, more severe hurricanes on the east and Gulf coasts, wildfires in the west, or regional climate changes affecting crop yields on the plains, climate change is affecting every state and community in our nation. These risks are intertwined in the financial system. Insurers can expect more claims related to extreme weather events. Lenders will see more risks in underwriting carbon-dependent industries, and economic changes will affect asset values across many sectors. Climate change is creating significant and complex risks in our financial system that we cannot ignore. Last month, President Biden signed an executive order directing the National Economic Council, the Treasury Department, and the Office of Management and Budget to develop a government-wide strategy evaluating and addressing climate-related financial risk and assessing the necessary financing to achieve net zero emissions by 2050. Several of the financial regulators have already begun work to understand climate risk. We can either work together in Congress and across the government to coordinate sensible policies to evaluate and mitigate financial risk related to climate and help our economy transition to a carbon-neutral future, or we can wait until the market and the consequences of climate change dictate such actions for us. Last week, I reintroduced the Green Neighborhoods Act, a bill aimed at making the housing sector more energy efficient and ensuring workers can get trained for green jobs. This is one example of how Congress can help facilitate an orderly transition of our economy and make the housing sector greener. The canary in the coal mine has stopped singing. We must act now to ensure our financial system is resilient in the face of climate change and the economic transition. Today's hearing will examine physical and transition risks posed by climate change and how financial regulators can work to evaluate and mitigate these risks. I look forward to our discussion today so we can ensure our financial system is ready for what's coming ahead. With that, I now recognize the ranking member, Mr. Luetkemeyer from Missouri, for 4 minutes for an opening statement.
Thank you, Mr. Chairman. Climate risk has certainly been a buzzword both within the banking industry and within the Biden administration. The administration has issued multiple executive orders focused on climate risk. Specifically, the executive order titled Climate-Related Financial Risk, which requires FSOC to assess climate-related financial risk to the stability of the federal government and the stability of the financial system. Amongst the administration, the Federal Reserve has been the most active regulator in this space. In May, they announced the establishment of the Financial Stability Climate Committee to identify, assess, and address climate-related risk. Furthermore, the Federal Reserve has requested information from lenders on how they handle climate risk at their institutions. Let me be clear. Federal regulators should understand how financial institutions are handling risk mitigation in their lending portfolio. This includes numerous types of risk, including credit risk, concentration risk, and default risk. However, the inclusion of climate-related financial risk must be better understood by both regulators and financial institutions before any framework around this risk can be initiated. It is clear certain financial institutions, particularly the largest U.S. firms, are including climate risk in their risk assessment processes. The U.S. GSIBs have all limited their approach to carbon financing in one way or another. Some have pledged to provide investments in sustainable businesses and technologies, and others have pledged to reach net zero greenhouse gas emissions in their financial activities by a certain year. As the economy and consumer demands change, it is appropriate for financial institutions to change as well. Ensuring your lending and investment portfolio is diversified and risk-averse is a core tenet of risk management. However, as financial institutions move in the direction of sustainable investment, it is appropriate to determine if the U.S. economy, in particular the energy industry, is ready to move away from fossil fuels and carbon-intensive energy. Will the energy sector be choked off from financial services they need to exist? What are the costs of the transition risks to the U.S. economy? These are questions that must be seriously considered and understood before an industry-wide stance is taken regarding investments in carbon-intensive industries. While federal regulators should understand these risks, I must associate myself with the comments of Vice Chairman of Supervision, Randy Quarles, who said, broad climate policy is the role of Congress and other federal agencies, not the Federal Reserve. Congress should not deputize the financial services industry to be the climate police, greenlighting sustainable projects and shutting down legally operating businesses that are carbon intensive, especially when they have no understanding of how climate risk will impact the economy and do not have sufficient data and modeling to determine these impacts. The CCAR stress testing amongst financial institutions looks 9 quarters into the future. Most climate change models look about 30 to 100 years in the future. If we go down the path of forcing institutions to speculate on future risk and tying their capital requirements to this risk before we have an appropriate understanding of the economic impacts and the effect on access to credit and the ability of the energy sector to pivot to new technologies, we could do irreparable harm to our economy. And yet, that is exactly what my colleagues on the side of the aisle are proposing. They have noticed legislation this hearing that would directly tie climate-related risks to bank capital by increasing the risk weighting of assets financing GHG emissions. This is an extremely irresponsible proposal. Again, we have no understanding on how this would impact the economy, no real data on how this would impact the world's climate, no clear information on how we can accurately predict climate-related financial risk, and no clear understanding on how transition risks could impact the safety and soundness of financial institutions and the U.S. economy at large. I look forward to bringing up these concerns with the panelists today. And with that, Mr. Chairman, I yield back.
Gentleman yields back. The gentlewoman from California, the chairwoman of the committee, Ms. Waters, is now recognized for 1 minute.
Thank you, Chairman Perlmutter. Over the past year, we have witnessed examples of how climate change can disrupt our financial system. The financial toll, including insurance losses from the most devastating wildfire season on record, grew so sharply that our governor in California had to issue a moratorium to prevent insurers from denying insurance coverage to homeowners. Meanwhile, the hundreds of bankruptcies in the oil and gas sector as a result of the economic fallout from COVID-19 has provided a preview of the type of pain our economy will likely face as climate change becomes worse. I'm pleased that President Biden, Treasury Secretary Yellen, and policymakers at the Fed and elsewhere have listened to those of us who have raised concerns about urgent financial stability risk of climate change and that they are beginning to take action. So I'm looking forward to the hearing today, and I assure you Chair Perlmutter, that we're going to be hearing from Seattle and Portland. Portland was 116 as of yesterday, Seattle 104 as of Sunday. And I don't know what financial disruption this is going to cause, but climate change is real. I yield back the balance of my time.
Gentlelady yields back. The gentleman from North Carolina, ranking member of the committee, Mr. McHenry, is recognized for 1 minute.
Well, thank you, Chairman Perlmutter. You've heard me say this before. I've said it repeatedly. Climate change is real. But instead of taking the time to get this legislation right, my Democrat colleagues are once again rushing to legislate to appease the progressive left. Unserious policies will have far-reaching and unintended harmful consequences. So just as the so-called Climate Crisis Financial Stability Act, without doing any work, without listening to any experts, without any data, Democrats will take the step of determining, or the Democrats want to take the step of determining risks for financial institutions and punishing certain institutions with a capital surcharge. Now, not only is this unrealistic, I think it's a dangerous step. We need to make sure that any next step strengthens the resiliency of the system and seriously addresses climate risk, not appease some progressive stakeholder group. I yield back.
Gentleman yields back. And I'd just like to alert the members and the panelists, we are expecting votes probably around 3 o'clock. And what I'd like to do is to get through the statements of all the witnesses as much as we can before we have to take a break for those votes. And if we can get some questioning in before the votes are called, we'll do that. Otherwise, we will recess until we finish the votes on the floor, and then we'll reconvene once the votes are finished for questioning. So with that, I would like to recognize and tell you who all our witnesses are. First, we have Professor Hillary Allen. She's the Associate Professor of Law at American University. Ms. Allen's research is focused on domestic and international financial stability regulation, and she teaches classes in banking law, securities regulation, financial regulation, and other topics. Dr. Rachel Cletus is a policy director with the Union of Concerned Scientists. Dr. Cletus is an economist with 20 years of experience working on climate and clean energy policies and is an expert on the United Nations Framework Convention on Climate Change Process. Ms. Mayra Rodriguez-Valladares is the managing principal with MRV Associates. Ms. Rodriguez-Valladares is an independent consultant who has advised central banks, insurers, regulators, and financial services firms on risk and compliance issues. Mr. Stephen Rothstein is the managing director of Cirrus Accelerator for Sustainable Capital Markets. Mr. Rothstein's work at Cirrus Accelerator is focused on transforming practices governing capital markets to reduce the financial impacts of the climate crisis. Finally, Dr. Clifford Rossi is the executive in residence and professor of the practice at the Robert H. Smith School of Business, University of Maryland. Dr. Rossi has almost 25 years of experience in government and financial services and has held senior roles in risk management at several of the largest financial services companies. Our witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer on your screen or on your desk in front of you that will indicate how much time you have left. When you have 1 minute remaining, a yellow light will appear. I would ask that you be mindful of the timer and when the red light appears to wrap up your testimony so that we can be respectful of both the other witnesses and the committee members' time. Without objection, your written statements will be made part of the record. Professor Allen, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you, Chairman Perlmutter. Thank you also, Chairwoman Waters, Ranking Member McHenry, and Ranking Member Luetkemeyer. Thank you, members of the committee. I very much appreciate the opportunity to testify at today's hearing. As Chairman Perlmutter already mentioned, my name is Hillary Allen, and I am an associate professor at the American University Washington College of Law. I teach courses in corporate law and financial regulation, and my research focuses on financial stability regulation. Prior to entering academia, I spent 7 years working in the financial services groups of prominent law firms in London, Sydney, and New York. And in 2010, I worked with the Financial Crisis Inquiry Commission, which was appointed by Congress to study the causes of the financial crisis of 2008. The views I am expressing today are entirely my own. They do not represent the university, American University, or any other institution. In my testimony today, I would like to highlight 3 points for the committee. First, I will underline the stakes involved in preparing the financial system for the physical and transitional risks associated with climate change. The impacts of financial crises can be irreversible and catastrophic, particularly for the most vulnerable members of society. And so financial regulators should take steps to make the financial system more robust to the climate-related uncertainty that we face. Second, I would like to advocate for increased focus on the potential systemic effects of operational problems arising from extreme weather events and other environmental changes, because financial stability regulation often neglects these operational risks. Finally, I will speak about reforming the Office of Financial Research, known as the OFR. All of the federal financial regulatory agencies need to be involved in making this financial system more robust to climate-related threats, but the OFR can play a unique and crucial part in that effort if it is rebuilt as an interdisciplinary hub of the different kinds of expertise needed to assess and respond to these threats. It has never been good policy to just let financial crises happen and then clean up afterwards. Even with the Herculean and imaginative crisis response efforts that we saw from the Federal Reserve and other governmental bodies in the wake of the financial crisis of 2008, the economic fallout of that crisis could not be fully contained. Many of the most vulnerable members of our society still have not recovered from it. I therefore urge the committee to take a precautionary approach to financial stability regulation in general and in particular towards climate-related risks. A precautionary approach requires us to be creative in our thinking about risks to financial stability and favors bold, simple responses where possible. I have outlined a number of responses in my written statement that are designed to help manage the uncertainty about the precise physical and transitional risks we face, including regulatory capital requirements that require banks to fund themselves with more common equity to act as a buffer against uncertainty and help prevent financial institution failures and asset fire sales. One reform that I want to stress for the committee today is the need for what I call macro-operational regulation, which takes seriously the possible systemic consequences of the steps taken by individual financial institutions to manage their own operational risks. For example, a financial institution that finds part of its physical infrastructure damaged could shift its operations to alternative infrastructure. That would be a rational step by the institution designed to enable it to keep providing financial services, but if that alternative infrastructure is overloaded as a result, that may create problems for other financial institutions that also rely on the alternative infrastructure. Different kinds of experts are needed to help think creatively about the types of threats that climate change poses for the financial system. In the case of the operational risk spillovers that I just mentioned, complexity science expertise would be very helpful. Climate scientists and environmental economists will obviously be crucial to the effort. Data scientists and software engineers would also make important contributions. The Office of Financial Research should be the new home for these types of interdisciplinary personnel, because consolidating interdisciplinary expertise in one agency can create virtuous cycles that make hiring easier and promote collaboration and consistency in responding to new threats. In my written testimony, I set out proposals for rebuilding the OFR as an interdisciplinary expertise hub. Many of these proposals relate to staffing and to the OFR's relationship with other financial regulatory bodies, particularly the Financial Stability Oversight Council. I urge the committee to pursue these proposals as a matter of urgency in order to ensure that our financial regulatory architecture is equipped to deal with the challenges of climate change. Thank you.
Thank you for your testimony. Now I'd like to recognize Dr. Rachel Cletus for 5 minutes for her testimony.
Thank you very much, Chairman Perlmutter, Ranking Member Littmeyer, and members of this subcommittee for providing me the opportunity to testify remotely here today on the systemic risks of climate change. My name is Rachel Cletus, and I'm the Policy Director for the Climate and Energy Program at the Union of Concerned Scientists. Summer has barely begun, and we're already in the midst of a stunning drought in much of the western U.S. Record-setting heat waves are underway, including an unprecedented one in the Pacific Northwest. The Midwest has been hit by heavy rain and flash flooding. The wildfire season is underway, another intense one. We are projected to have an above-normal hurricane season. Meanwhile, the COVID-19 pandemic and the economic crisis continue to be a threat. What we're experiencing this summer is part of a very sobering trend. In addition to steadily rising temperatures, climate change is also driving accelerating sea level rise and ocean acidification. Many sectors of the economy are at risk. Our infrastructure, agriculture, fisheries, insurance, real estate, tourism, and the impact on health and safety of people, including outdoor workers, is very significant too. Our nation experienced $22 billion plus extreme weather and climate-related disasters last year. Climate-related infrastructure disruptions are increasing. Our roads, bridges, rail lines, air travel are all at risk. The electricity system, which underpins our daily lives, has repeatedly failed. Heat waves put enormous pressure on the power grid right at a time when we need power for cooling. We get power outages, as we're seeing in the Northwest right now, which can trigger cascading effects, including business interruptions and loss of critical services that depend on electricity. Meanwhile, heat trapping emissions that fuel climate change are still rising. The science is clear. We need to cut emissions by half in 2030 and get to net zero no later than 2050. And yet today, our economic and financial systems are not accounting for these risks, nor are they helping drive a rapid shift to a net zero economy. A combination of short-sightedness, inadequate policies, the outsized power of fossil fuel companies, and business as usual inertia is getting in the way. And if we fail to take action now, the potential for severe shocks to our financial system will grow. And as with previous crises, the impacts will be especially harsh for those who can least afford it, low-income households, communities of color. Instead, we have an opportunity now to ensure that our economy and financial system are put on a path to be fairer, more climate resilient, and compatible with a low-carbon future. We need a coordinated, comprehensive approach from the national to the international to the local level, with Congress, financial regulators, and the federal government all playing their part. We need mandatory risk disclosure in the marketplace to help correct market failures. Fossil fuel companies and their investors who bear an outsized responsibility for climate change must face market pressures to change their business model and lending practices. We need transparent, uniform disclosure of market risk from climate change based on the best available science. Congress must pass legislation to set up an advisory committee on climate risk in the FSOC, require climate risk disclosure in the marketplace, and take steps to prioritize the well-being of marginalized communities. Much more is at stake than the fiscal well-being of U.S. businesses. The public relies on these companies to grow and manage our savings, investments, pension funds, energy choices. Our market rules and financial safeguards must help develop the outcomes we need to protect our health, welfare, and prosperity, not simply the profits for the powerful and elite few. We need a transformative climate strategy that addresses underlying systemic challenges like structural racism and socioeconomic inequities. We have urgent choices before us, but because it's our actions that are the source of heat trapping emissions, here in one of the most powerful economies in the world, we can also help set the rules of the market. We cannot have a healthy economy if the planet is on fire and vast areas are underwater. Thank you for this opportunity to testify today and for your efforts to protect our financial system from climate risks and to ensure that it helps contribute to the climate solutions we so urgently need.
Thank you, Dr. Cletus, for your testimony. Ms. Rodriguez Valladares, you're now recognized for 5 minutes to give your oral presentation of your testimony.
Chairman Perlmutter, Ranking Member Lutkemeyer, and distinguished members of the subcommittee, thank you for the opportunity to appear before you. I am Mayra Rodriguez Valladares, Managing Partner of MRV Associates. For over 3 decades, I have worked with bankers and financial regulators in over 30 countries on a wide range of risks that can threaten financial institutions' safety and soundness. Unlike the global financial crisis, scientists have been warning us for decades about the danger of climate change. Through the numerous financial crises I have endured, I have learned that when someone tells me this time it's going to be different, It is a warning signal that urgent action is critical now to avoid another painful crisis. U.S. globally systemically important banks are very exposed to climate risks. Not only do they provide financial services in states vulnerable to intensifying climate events, they have operations in foreign countries such as the UK, Japan, Canada, and Mexico, which are exposed to physical and transition risks. Regional, community, and agricultural banks are also exposed to climate change. In 2019, severe flooding in the Midwest brought loan defaults and payment challenges to their highest levels in 20 years. Banks in areas that serve people of color are also vulnerable to climate change, since many of them are also in areas with a myriad of environmental, infrastructure, and housing challenges. I must note that the very significant rise in corporate leverage in the United States in the last 2 decades means that those companies are the most likely to default in the event that they're affected by climate change. Market investors have not priced in climate change risks because financial institutions and corporations are not required to identify, measure, control, and monitor their climate-related risks and to disclose them to the public. Opacity in the financial system is dangerous to investors and ordinary Americans. Through its membership of leading international standard-setting bodies such as the Financial Stability Board and the Basel Committee on Banking Supervision, U.S. regulators already work on climate change risk frameworks. In the U.S., the Financial Stability Oversight Council and its Office of Financial Research should be given the necessary human, data, and technological resources so they can analyze how climate change is impacting the entire financial system and to detect sources of systemic risk. Inaction is costly. FSOC and OFR should focus on non-banks that are exposed to climate-related risks. They are interconnected to banks, do not have strong management requirements, and are very opaque. Under Basel III, Pillar 1, bank regulators can require banks to model operational risk, which includes natural disasters that can hurt a bank's assets, both in the banking and trading portfolios. Under Pillar 2, banks can incorporate different risks, including climate change-induced defaults or market volatility, into their internal capital adequacy assessment processes to determine economic capital levels to sustain unexpected losses. I respectfully recommend that financial regulators, especially the Federal Reserve, OCC, and FDIC, recommend to them that they, 1, should create climate change stress tests or add climate change scenarios to existing supervisory exercises, such as the Comprehensive Capital Analysis Review and Dodd-Frank stress test. 2, design specific climate change supervisory guidance for banks. 3, update supervisory bank examination manuals to include how climate change impacts banks. 4, conduct a review of their human resources to determine if they have enough professionals with knowledge about climate science, risk data aggregation, and modeling. 5, review if they have robust technological systems to analyze climate change data and its impact on banks' risks. And 6, address their climate change data gaps. I also recommend that bank regulators require banks to, 1, conduct a gap analysis to determine what resources they need to improve risk data aggregation, climate change risk modeling, and technology. 2, incorporate physical and transition risks into their enterprise-wide risk management frameworks and long-term financial plans to measure their climate risk exposures. And also to include in their bank recovery and resolution plans and their comprehensive liquidity assessment reviews how physical and transition risks impact banks' funding, cost of borrowing, liquidity, and risk mitigation ability. And lastly, to disclose to the public climate change model results, including tail risks, via Basel III's Pillar 3 disclosures. I look forward to your questions, and I would be pleased to serve as a resource to you in the future as you continue to explore how to reduce the adverse impact of climate change on the safety and soundness of the American financial system. Thank you.
Thank you very much for your testimony. I'd now like to recognize Mr. Rothstein for 5 minutes for his oral testimony.
Thank you, Mr. Chairman. My name is, and distinguished members of Congress, thank you for the invitation to be here. My name is Stephen Rothstein, and I'm the Managing Director of the Ceres Accelerator for Sustainable Capital Markets. Ceres is a nonprofit organization working with investors and companies to build sustainable leadership within our firms and drive policy solutions throughout our economy. Our membership represents Fortune 500 companies and investors with over $30 trillion of assets under management. Our testimony draws from series reports that we've also submitted into the record, Mr. Chairman. I'm not here to talk about the systemic risk our climate has to our planet and our people, although it is paramount to the lives of our children and grandchildren. I'm here to highlight the under-recognized risk to the safety and soundness of our financial institutions due to climate risk and the risks of the business-as-usual approach of some of the financial institutions pose on a livable, climate-safe world. If a banker or a bank regulator suggested they don't need to plan for another pandemic or a cyber attack, there would be a chorus of opinions saying they're not meeting their fiduciary responsibility. Potential exposure to climate risk is bigger and more systemic, yet there are leaders today in banking, insurance, and among financial regulators that do not fully account for financial risk. Even as we're working to overcome the unprecedented pandemic and the pain and loss that it brought, we have simultaneously had record-breaking fires, hurricanes, and unparalleled climate-related risks. As our Secretary of State said recently, we're running out of records to break. In short, we know more about the climate risk, as the chairman said in his introductory remarks, than we knew about the mortgage finance risk in 2008. But surprisingly, we're not acting with the urgency required. There are dozens of strong international examples from financial regulators around the world, and we appreciate the initial steps from the Department of Treasury, the Federal Reserve, and the SEC. But that's all they are, initial steps. So we recommend regulators take 5 immediate steps. 1, essentially, immediately affirm the systemic nature of climate risk and its impacts on the financial market. The affirmation can take the form of a statement of the agency chair or a report from the agency. 2, activate action on prudential supervision, as some of my colleagues have said. U.S. regulators have explicit responsibility to supervise the risks that financial institutions take on. Consistent with that mandate, financial regulators should integrate climate change into the prudential supervision of banks, insurance companies, and other regulated financial institutions. The Federal Reserve, in particular, should take immediate steps to assess the climate risk to financial markets and mandate scenario analysis by the banks and the other financial institutions it supervises. They should also outline plans for conducting pilot climate stress tests of its supervised institutions to measure the impact of climate-related shocks and consider enhancing capital and liquidity requirements. In addition, we recommend the Federal Reserve, FDIC, OCC, and the National Credit Union Administration expand their examiner training programs and manuals to ensure that staff fully understand climate risk faced by the financial institutions they monitor. 3, support the SEC's work on mandatory climate disclosure. We congratulate the SEC for their initial steps and hope they'll be issuing bold rules later this year. 4, address how climate risks further exacerbates the systemic racism, particularly reflected in financial institutions. Financial regulators should develop strategies to address systemic climate risks and structural racism in an integrated way. The Community Reinvestment Act is ripe opportunity to do this. 5, build capacity for smart decision-making on climate change by coordinating action with other U.S. and global regulators and by hiring and training additional staff. Coordinated action by U.S. regulators at the global, federal, and state levels is essential to accelerating this address. The FSOC generally and the Biden executive order that's been referred to are critical steps. We appreciate the recent actions of U.S. financial regulators to coordinate with global peers as a start. To conclude, U.S. financial regulators have a critical role to play in ensuring the resilience of our economy, weakened by the global pandemic, systemic racism, and threatened by future climate shocks. The fundamental safety and soundness of our financial institutions is relying on them and in each of you. Thank you again for this opportunity.
Thank you for your testimony. You did that right on 5 minutes, so I appreciate that. Dr. Rossi, you are now recognized for 5 minutes. I think you're on mute, sir.
Thank you, Chair Perlmutter, Ranking Member Luetkemeyer, and members of the subcommittee. I'm Dr. Clifford Rossi, professor of the practice and executive in residence at the Robert H. Smith School of Business and the University of Maryland. The views that I'm expressing today are solely my own and do not represent those of the University of Maryland. I'm here today to inform the subcommittee that imposing climate risk mandates on regulated depository institutions at this time would be detrimental to consumers, the financial services sector, and economy at large. Let me be clear. Climate change is a real risk that requires a firm understanding of the current limitations of climate models, underlying data, how those data do and do not integrate with standard financial risk models, and numerous other components in order to craft effective solutions to the underlying risk. Now, I offer our unique perspective on this issue, having worked for about 23, 25 years, depending on sort of how you calculate those things, in the financial services industry, first as a regulator during the S&L crisis, and then at both Fannie Mae and Freddie Mac pre-conservatorship, as well as at one of the largest commercial banks, the largest savings and loan, and the largest non-bank mortgage company during my tenure as a C-level risk executive, and now as a finance and risk professor working on climate risk issues in banking. Models in use today for climate scenario analysis are designed to represent the physics of a complex Earth system well into the future, and their output is limited near-term use by financial institutions. As I have outlined in my written testimony, the models upon which urgent demands for public policy response are based are subject to significant model risk. Model risk can be defined as the risk associated with errors in data, methods, or assumptions used to generate output from analytical models used for decision making. Forcing financial institutions and their regulators toward expansive climate risk regulation based on effects that are not well understood presents more risk to the financial system than a staged and methodical approach. Now, I applaud the intent of the Biden administration through their executive order to assess climate-related financial risks and data. However, I would caution policymakers and regulators from imposing measures on regulated depositories based on the state of current climate analytics for the following reasons. First, the output from climate and associated integrated assessment models, or IAMs, are not close to being ready for use in bank financial and risk analytics, such as bank stress test modeling, and suffer from the supposed square peg in the round hole syndrome. The empirical linkages between long-term climate effects and short to intermediate-term financial and risk factors are not sufficiently established currently to properly assess physical or transition risk impacts to the banking system from climate change. Second, both the climate and integrated assessment models upon which scenarios, such as those proposed by the NGFS, are based are subject to considerable empirical error due to the underlying complexity of these models on interactions that are not fully understood in the scientific and financial research communities. Now, why is this important? Requiring banks to make hard money strategic decisions on lending, capital allocation, pricing, and other activities that have long-term consequences for consumers, the financial system, and economic growth based on models with a high degree of uncertainty is not at all consistent with prudent model risk management practices. Third, it is well established in the psychology and economics literature that decision-making is affected by a number of cognitive biases. One of these is what I refer to as model or shiny object bias. Model bias occurs when decision makers embrace the results from highly sophisticated quantitative models based on perceptions that the apparent analytical rigor in those models necessarily translates into accurate and reliable outputs. There is widespread shiny object bias in the use of climate and IAM models today among policymakers worldwide. This poses serious concerns regarding the use of these models for anything other than research applications at this time, as described earlier. Placing bets on financial markets on such models invites a host of long-term unintended consequences on the financial system. Climate change is a real risk that banks and other financial institutions should actively incorporate in with their existing risk management processes. However, such firms must take measured steps to understand these risks and not be forced into conducting analyses for which the models and outputs are not well understood as they relate to financial services. Banks should instead focus attention on bolstering their risk awareness to climate change, starting with enhancing their risk governance, process and controls, data and analytics. Quantifying with a reasonable degree of confidence the impacts of physical and transition risk from climate change will require significant effort, time, and a true interdisciplinary approach between climate scientists and the very people that are actually running these financial and risk management at these organizations in gathering additional data and modifying existing models. This work should commence, and only when the results have been deemed to conform to regulatory model risk standards should consideration of their disclosure and use in financial decision-making be permitted. Thank you for your time and the invitation to testify in this important matter, and I look forward to answering your questions.
Thank you, Dr. Rossi, and thank you to the panelists. You were all right on time or a little early, so appreciate that. I'll recognize myself for 5 minutes for questioning, and we will get through as many of the members and questions as we can before we have to break for votes. And we might be lucky and get through all of us. We'll see. Dr. Rossi, I want to just start with where you've left off, and I think we would agree. A number of us on this committee are also on the Science Committee, and yesterday we had a hearing on the science of wildfires, or wildfires predictions, mitigation, or a whole variety of things. And I don't think we would disagree with you that we don't have all the science we would like to predict wildfires. Colorado, we had our worst wildfire season ever last year, and most of the Northwest is frying right now. But in my opinion, that's not a reason to not begin to put precautions in place. So, Dr. Cletus, Colorado, as I just said, had its worst wildfire season on record. The 3 largest wildfires in our state's history occurred in 2020, torching over 540,000 acres. Climate change is now forcing Colorado and many other states to prepare for larger and more destructive wildfire seasons. In fact, the director of the Colorado Division of Fire Prevention and Control just remarked, we're having fire years, not fire seasons anymore. In the West, we have wildfires. The Gulf has hurricanes. There's increased flooding in the South and the Midwest, and these changes are having significant impact. The smoke that comes into the Denver area from the wildfires, either in Colorado or the West, is affecting our tourist industry and our housing industry. So as the severity and frequency of extreme weather events continues to rise, how will the housing market react, and what does it mean for homeowners in climate-sensitive areas?
Yeah, as you're pointing out, the reality is this is not some distant future. These climate impacts are here and now, and it's very clear from the science that hotter, drier conditions in the West are contributing to these longer, more intense fire seasons. It's undeniable. And unfortunately, the uncertainty to the extent it exists seems to be breaking in the wrong direction. This is why the precautionary principle that the other panelists highlighted is so important. We're talking about managing risks. We cannot avoid them completely. And what we're starting to see is in the insurance market reflecting this risk with wildfires, where we've seen insurers drop policyholders, try to raise rates. State regulators have had to step in with stopgap measures. We have thousands of homes at risk right now in the West, millions actually, if you look at across all the states in the American West. And this risk is growing both because of climate change and also our development patterns and how we manage our forests. So we have to act on all fronts to make sure that we contain this risk. Otherwise, both the economic consequences as well as the public health and human toll will rise every year, unfortunately.
Thank you for your answer. Several of us on this committee, I was a bankruptcy lawyer representing financial institutions for many years. We've got individuals who are bankers or bank regulators on this committee. And, you know, the failure of Pacific Gas and Electric, the failure of many oil and gas companies and their bankruptcies make me concerned about the impact on the financial industry. So, Ms. Rodriguez-Valladares, 2 years ago, this subcommittee held a hearing about how leveraged lending may pose a threat to financial stability. As you know, leveraged loans are characterized as corporate debt extended to highly indebted non-financial businesses. How does leveraged lending interact with climate risk, and what types of institutions are particularly exposed?
This is really a very good point that you make. I have published about 40 some odd articles about leverage lending and collateralized loan obligations. And we should definitely be very concerned because American companies are more leveraged than they ever have been historically, either in aggregate amounts or when you see it as an equivalent percent of GDP. And there's incredible interconnections because a lot of these companies, especially the energy sector, which presently is exhibiting a very, very high default probability, are incredibly vulnerable to extreme climate events. And there's a lot of opacity in leverage lending and collateralized loan obligations. And there's a lot of interconnections between the non-banks such as hedge funds and private equity, home offices, and other types of financial institutions of that nature. They're very interconnected to banks. They hold a lot of these leveraged loans and a lot of these securitizations. So we definitely need to be very, very mindful about their probability of default, and especially those companies that are imminently affected either by the physical or the transition risks.
Thank you very much for your response. My time has expired. I'd like to recognize the gentleman from Missouri, the ranking member, Mr. Luetkemeyer, for 5 minutes.
Thank you, Mr. Chairman. Mr. Rossi, in your testimony, you have a graph in there, and it says long-term changes to the Earth system. And the first graph talks about land surface temperatures, and it starts out at 1850. And it's interesting because that seems to be where most people who want to talk about climate change want to start. It's 1850. It's interesting because that's actually the trough of the cold trend that started at that point, or ended at that point. So if you actually take the chart and you go back 1,000, 2,000 years, you see this wave effect. And so what I'm saying is, if you take that chart and go the other direction, which is what we're trying to talk about today, actually within the next probably 25 to 50 years, you're going to see the wave start going the other direction. And so we're talking here today about modeling. If you go back if you're in the banking business and you're trying to model what your risks are with regard to climate change, you go back 5 years or 50 years is one thing, and you look forward then 5 years or 50 years based on what you saw in the past. That's really, you need a crystal ball to look at all the things that have happened in our economy and in the world in the last 5 years or 50 years, and then try to project that to the next 5 years or 50 years, and look at, and you throw in there the technology, things like that. So how do you, Dr. Rossi, or Mr. Rossi, analyze this when you look at the fact that this wave could actually go the other direction? And we're looking at trying to model this so we actually get an assessment of true risk. How can you do that? I mean, you just got talking about that you didn't think that could actually work. Can you elaborate a little bit? Or am I wrong on my assessments here?
No, and as someone who actually either developed or oversaw the development of such models in the past, either loan loss reserving models or stress test models, I can tell you for sure that this is probably one of the most difficult, if not the most difficult exercise that banks will face in estimating or assessing risk in their portfolios. And as for all the reasons that you just described, in the case of credit risk or market or liquidity or these other risks that are out there, we can get our arms around that pretty readily because we have that data. We have that historical time series, that is, to be able to kind of ingest that into our financial risk models and project out how much capital we'll have. When we're talking about taking physical outputs, such as how many gigatons of greenhouse gases are spewed out, and trying to translate that into macroeconomic factors that then translate in turn to how much risk are on our lending or investment portfolios, that's what we're talking about is being extraordinarily difficult to do. And keep in mind that when we do that, we're today really only going out, as was said earlier, 9 quarters forward on our stress tests. So trying to go out 5 years or even 10 years or more than that, it creates an enormous amount of uncertainty, such that if we're trying to estimate the tail of the distribution, as other witnesses have talked about, the tail of that distribution is so noisy, it would be very, very difficult to quantify that with any degree of reliability. And personally, as a former CRO, signing a sub-attestation, I would not today, given where the state of climate models are today, sign any sub-attestations related to climate risk.
And the concern, I mean, you take that one step further, then the concern that we need to be thinking about here is if you destroy the fossil fuels industry based on this graph showing continued warming, and all of a sudden in a few years it turns the other way. We've destroyed an industry that we definitely need and are going to need in the long term for many different reasons. It would seem to me that we need to be very careful how we go into this modeling situation. Would you agree with that?
I would agree with that. And I want to be clear here. I'm saying not do anything. I'm not saying that. I'm saying we need to start in a very methodical fashion. There are things that we can do today that aren't going leapfrogging to let's adopt what's in these IAMs and climate models today and just start to implement stress tests and impose 150% capital risk weight.
Let me interject real quickly here. You talked about some things we can do today. Would you identify things financial institutions or regulators can, what significant data things they can actually put together today to actually make it work?
Yeah, absolutely. The first and foremost, right? And I'm a simple-minded guy when it comes to these things. Is do what you understand right now. What banks can understand right now are the positions on their portfolios that are exposed to different climate events. They can actually engage with vendors that are out there that can supply this information, that can help them assess what their exposure is to wildfire risk or drought or flooding. And they can size that up in terms of the probability of those outcomes as well as the impact or the severity of those outcomes. They can do that today. The other thing that they can do is start to do like what I've done in an academic research paper that will be published later this year, that you can actually try to determine these empirical linkages between physical outputs, such as, say, hurricane impacts, severity and frequency of hurricanes, to, let's say, mortgage default. Trying to establish those empirical linkages will be extraordinarily important to actually getting a better handle on estimating what this climate risk looks like on these bank portfolios.
Thank you for your response. I'm out of time. Thank you, Mr. Rossi.
Thank you, Dr. Rossi and Mr. Luetkemeyer. The chair will now recognize Mr. Foster, Dr. Foster, the only physicist in Congress, but apparently he's going to yield to Mr. Caston, an engineer.
Thank you, and I yield to Mr. Caston.
Thank you, Mr. Physicist. I truly hope we're not still arguing about whether climate change is real. My goodness, the science is so settled. We know the last time CO2 was this high, sea levels were 50 feet higher. Let's move on. If you don't believe the scientists, listen to Lael Brainerd, who said in January that the science is settled, but the impact on our financial sector is highly uncertain, and that we should be concerned about the impact of rapid repricing events. I'm partially misquoting that. When we had the Jamie Dimon in a couple weeks ago, he said that JP Morgan is not reducing their fossil fuel exposure, and I said, okay, have you changed your senior debt, sub-debt equity level? He said, no, not yet. And I said, can I assume you will once you see things coming? And he said, oh, absolutely. And so my first question for you, Mr. Rothstein, is we know once these changes come, the sophisticated players will see it coming first, and we'll have capital movement in the system. Can you explain to us a little bit the difference between stress testing the banks and scenario modeling the system, and how you think we should be balancing those two to make sure that our system is robust and continues to be robust?
Thank you, Congressman. Thanks for all of your leadership on this issue. We have a very diverse system with thousands of banks. And most people, while the biggest banks obviously are responsible for the loans, most people operate with small banks. They have to deal in a very concentrated area. So they're more risk for physical risks because they tend to loan within a 5 to 10 mile area. We did an analysis of the largest 20 banks and looked at their syndicated loan portfolio, just used the same methodology that the European Central Bank did. And for that, we identified over $500 billion of exposure. So what we need to do is use every tool. This is an all of government initiative. It's an all of society initiative. Climate change is. So we have to do stress tests on individual bank portfolio, and then we have to look at scenario analysis for the whole system.
Small and
large.
I want to follow because your point about small banks intrigues me, because there's the physical risk that at least we think we understand. I mean, there's lots of ripple effects. But then there's the transitional risk that shifting wealth from energy producers to energy consumers is good for Americans, but it creates our political tension. And I find myself thinking, is the First Bank of Frankfurt, Kentucky going to be okay? Does this feel more like the SNL crisis than the 2008 crisis to you, as far as we think about where how diverse the exposure is going to be in the system?
I believe, Congressman, that the exposure is even broader and more systemic than either of those. So if for a small bank, they could be affected on physical risk if they're in an area with fires, flood, tornadoes, but they also could be if they're in an area that's an energy producing community and the jobs decline in that sense. You know, last year, the oil companies wrote off $145 billion of assets in the first 3 quarters. That's banks, insurance companies, investors that are somehow dealing with that. So that this is deeper and wider potential area of exposure than any of those.
As I pointed out recently, ExxonMobil didn't write off all that money because they were woke. I want to shift, if I could, with the little time I've got left, to Ms. Rodriguez Vallardes. Really appreciated your comments, and I was in the energy industry for 20 years before I got here, and we used to joke that you could always tell that there was a downturn coming in the energy sector because the big banks started creating special purpose energy opportunities fund 4. That was the thing they were doing to move assets into non-Dodd-Frank compliant vehicles, right? Assuming that we pass this legislation, including my bills that are noticed in this markup, and the Biden White House moves, we're probably 2 years away, realistically, from getting all these changes implemented. I don't know what you think of my own metric, but are there metrics you think we should be watching in the financial system that will be a sign that the sophisticated players are starting to offload risk onto other players? So what's the red lights you're watching that you think we should be paying attention to in these next few years?
One thing, of course, is to watch whether banks are increasingly selling their loans that are exposed to climate change. So are they selling their commercial real estate loans, ag loans, energy loans to special purpose vehicles? Then that tells you that they are trying to get rid of that risk because it weighs on their capital and their leverage requirements. I think also watching the number of loans that they underwrite to these sectors that are so sensitive to climate change is also another important signal. But it's not just about banks' exposure to these kinds of companies from the lending side. Let's not forget that banks also are in financial derivatives and repos with these different kinds of companies to also see whether that is lessening. That's another signal that they feel that this is of concern. I'm a little concerned about some of the comments that I'm hearing that we have no data to be measuring climate change risk and how it can affect default probabilities or how it can affect market volatility. Because if there's one thing Americans are known for, it's for data.
I'm going to interrupt you, and somebody else will let you finish your answer to that question. But thank you very much for your testimony. Thank the gentleman for his time. I'd now like to recognize the gentleman from Oklahoma, the ranking member on the Science Committee, Mr. Lucas.
Thank you, Mr. Chairman. Today's hearing is an opportunity to have a constructive dialogue on the issue of climate risk in the financial system. We know that the climate's changing and that global industrial activity has played a role in this. Further, I believe my friends on the other side of the aisle would agree that Congress and the regulators still have much to learn about the implications of climate change in the financial system. However, the argument that we are in a race against a ticking climate doomsday clock is counterproductive to achieving real progress on this issue. The United States has already made progress in science and innovation needed for cleaner energy production. Weaponizing the financial regulators to drive capital away from fossil fuels, still the most reliable and essential form of energy in the United States, would have dire consequences for the economy and U.S. competitiveness abroad. Instead, we need a more thoughtful approach based on the current state of climate risk assessment tools. Mr. Rossi, the electric power grid is absolutely essential to the U.S. economy and generating energy needed for businesses and families across the country. In 2020, fossil fuels were the largest source of U.S. electricity generation at about 60%. Nuclear energy was the source of roughly 20%. So, Dr. Rossi, could you speak to the potential consequences to the U.S. economy if we see a rapid government-driven disinvestment away from fossil fuels and nuclear energy?
Yeah, in the near term, we could see several things. So first of all, let me give you some perspective. These are numbers, I've been looking at the Citigroup recently, or a little while ago, had released their climate financial disclosure for this year. And in there, it was very interesting. One of the things that they flagged was their oil and gas exposure. And something in the order of like $50+ billion or so. Pretty sizable, but only about 6 or 7% of their overall exposure. Why that's important is because imagine now if you have multiple banks, just like what happened during the liquidity coverage ratio implementation several years back, when banks were looking at trying to measure how much liquidity they had on their balance sheet from a regulatory requirement standpoint, and found that some of those largest banks were certainly were not in compliance. And what would they do? They'd have to then rotate out of some of their lesser high quality assets into higher quality assets. So they would have to sell mortgage-backed securities in order to try and comply by buying U.S. treasuries. Well, in this case, divesting from oil and gas investments would actually have a further amplifying effect, downward movement effect, that is, for some time period, which would actually cause those prices of oil and gas to go down, those securities. And in addition, would temporarily anyway, would have impose some harm to the balance sheets of these banks. Now, I'm not saying it's crushing by any sense. They're well capitalized, so that's not going to be an issue. But from a knock-on effect standpoint, we're talking about impacts associated with a lack of investment if banks aren't lending again to oil and gas companies, their inability to do the kind of exploration that's needed to continue to provide us with the supply necessary to have heating and having to fuel our cars and that sort of thing. So it would have adjacent effects on increasing prices to consumers for things like utility bills, things for prices at the gas pump, etc. And so certainly would have adverse consequences in the near term for that.
Continuing with you, Dr. Rossi, you explained in your written testimony how climate credit default swaps could be utilized as a risk mitigation tool for the climate-related events. Could you discuss further how this financial tool could be used?
Sure. So the idea here is simply, and I think one of the other witnesses mentioned the use of financial derivatives by financial institutions. You know, and during the financial crisis, I think Warren Buffett famously said something that these were weapons of financial mass destruction or something to that effect. Actually, derivatives are an important risk mitigation tool that are used extensively in the industry for things like transferring credit risk to private investors, such as what's going on with the government-sponsored enterprises, Fannie and Freddie, in transferring credit risk off their balance sheets and on to other private investors. In the case here, we're talking about, we've had for many years weather derivatives, rainfall derivatives, and we've had temperature derivatives that have not really kind of taken off much in the industry. But as climate change accelerates and continues to evolve, we need to think about developing credit or climate-related derivative tools that could remove that risk off these balance sheets. You can imagine, right? So that both Fannie and Freddie, for example, that are engaged heavily in credit risk transfer of their securities or of their mortgage losses, that is, are exposed increasingly, potentially, to more hurricanes and flooding events if and when that occurs from climate change. So being able to transfer that off directly by way of, let's say, a climate derivative instrument, just like a CDS or a credit default swap, where there's a buyer and seller in that market for that, a bank or a GSE could, for that matter, could buy protection from a seller on the other side, and that's how that climate derivative could actually function.
Thank you, Dr. Rossi. The gentleman's time has expired. Mr. Vargas, gentleman from San Diego, California, is recognized for 5 minutes.
Mr. Chairman, thank you very much for holding this hearing. I want to thank all the witnesses for being here today. I found it actually very informative. Dr. Rossi, can I ask you a question first to begin? Have you ever seen hearings like this before with Congress? And when you have witnesses that testify?
I have actually testified twice before. Yes.
The way I think it usually works is this way. You have one side, it doesn't matter, but one side will say something, and then, you know, if they're in the majority, they'll have 2 or 3 witnesses, and then the last witness will say just the opposite. So, you know, that sort of analogous to the issue, do cigarettes cause cancer? Yes, you know, they do, and they destroy your lungs. And the next one, oh yeah, they cause cancer. Yes, they do. And then the last guy always says, no, you know, they're healthy. It keeps you thin and fit, you know. But in this case, I almost think that everyone agrees that climate change is real. Now, I've been arguing this point now for decades, and I've had a hard time with some of my colleagues on the other side accepting it. And I think you said it until I heard you say, with some of the examples given by my friends on the other side, well, this kind of happens in history, though, you know, kind of go one way and then the other way. Do you think that climate change today, a large part of that is because of human actions and what we do?
I do, and that's based on the fact that I work on a fairly regular basis with climate scientists now at the University of Maryland, and I've seen the data. I am not a climate naysayer, and I don't know that folks, you know, on the other side of your side are that either. I think what we're trying to figure out, though, is how best to move the ball along in a way that doesn't destroy the economy short term, while make sure that we have what we need to have to protect everybody from climate change.
Well, I have to tell you that I think that's a big step forward, honestly. I think that's a big step forward, just saying that the science is settled. Because I hear some of my friends on the other side say, well, wait a minute, but it does this all the time. And, we can't really do much about it. It'll destroy our economy. It'll destroy our world if we try to do anything about our actions. You don't agree with that?
I would say this. I'd say that there are long-term climatological effects that have occurred throughout thousands of years, and that there is no dispute. I also don't think that there's any dispute that there are human-based changes that have occurred over the last 150 or so years based on the data that I've seen. At the same time, we do need to take care about how we move forward because the models underlying that have significant issues. So I don't think we're debating the climate change. We're debating how we can best implement them into financial models.
No, I think I understood your testimony well. And you said, you got the shiny models and you chase the shiny thing. You find out the shiny thing is going to hurt you because it's not modeling it right. And you can do real damage to the economy and to these large companies and other companies. I think I understood that. And I appreciate your testimony. And I really do. I do think it's a huge step forward. I do want to ask Dr. Cletus, you said back 2020 that the nation experienced nearly 59,000 wildfires, burned approximately 10 million acres, about 40% of that was in California. And CAL FIRE now says that 3 million homes are at risk in California, about so much that in fact, we got to do something. What can we do? I mean, I have a bill that passed out of here with others about at least disclosures, at least disclosing this information. Don't you think that's a good idea, at least doing that?
I think this is the main problem here. We have a real information asymmetry going on in the financial sector. Believe me, there are sophisticated actors in the financial sector who have proprietary data sets. They're moving their assets around. It is the ordinary public that is being left exposed, the taxpayer that's being left exposed. We have done some research just using publicly available data from NOAA tide gauge data, looking at sea level rise and the risk to coastal property. What we found was that over 300,000 homes and commercial properties with a collective market value of $136 billion today are at risk just by 2045. That's within the lifetime of a mortgage issued today. So there are someone who's going to be left holding the bag when those houses start to flood.
I want to interrupt you just for a second to give Ms. Mayra Rodriguez Valladares an opportunity to tell us about that data you were talking about, because I think it was in. I have 23 seconds. Go ahead.
We have a lot of data in the United States, both from scientists. So we have just hundreds of years of scientific data that can be used. And we also have a lot of different kinds of probability of default data. We have incredible professionals in quantitative fields, both in and outside of financial institutions. So there is a lot there that we can be doing to model climate change risks, and models are dynamic. So we should be working on that already and not wait until it is too late.
Thank you. My time has expired. Thank you very much, Mr. Chairman.
Thank you, Mr. Vargas. Votes have been called, but I think we can get through the questioning of Mr. Posey, and then we'll take a recess, Mr. Lawson and Mr. Barr and Mr. Kustoff, and then we'll come back and conclude after we go through the series of votes. So those of you who aren't going to be asking can take off if you choose. I'd like to recognize the gentleman from Florida, Mr. Posey, for 5 minutes of questioning.
Thank you very much, Mr. Chairman. Dr. Rossi, we're here today to explore an expansive role of the government in our economy to reduce systemic financial risk. History suggests that government has repeatedly missed the mark on assuring such financial stability. What assurances do we have that government can and will do better than the private sector and individuals in assessing and responding to potential financial risks posed by climate change?
Well, I think if what you're asking is about whether or not we can regulate climate change by way of financial institutions, I think that's a tricky problem to address, right? Because on the one hand, as we were talking about earlier, forcing divestment, for example, or some variation of that from financial institutions out of oil and gas would very much have a negative impact. And so from a safety and soundness standpoint, when we think about what the role of those safety and soundness regulators are, they are there to ensure that the viability, the long-term viability of those financial institutions is in fact intact. Forcing them to implement some sort of changes in the way in which they're balance sheeting certain asset types is certainly not consistent with the way in which our economy or our financial system has gone in the past. So that's an issue that I see associated with that.
Thank you. Follow up on that, Dr. Rossi. We have in recent history faced some pretty large shocks. I recall the large oil price shocks from OPEC that plagued us for years before we attained recent energy independence. Look just over our shoulder, literally right now, at COVID-19. Should we now really start selecting out the risks of the day, like climate change, and build an entire new regulatory apparatus around them?
Well, here's the thing. Climate risk is depending on who you talk to, is a fairly long-tailed risk. It's not one, you could say, okay, today we had 115-degree temperatures in Portland and Seattle. There's a difference between weather and climate, all right? And so those things might in fact turn out to be predictive of longer-term climatological changes. But what I'll say from a risk management standpoint is, from a banking perspective, there are risks that financial risks, market, credit, liquidity risks that we need to be managing, and banks do manage those very effectively today. Credit risk, and then the non-financial risks, of which I'd include operational risk. Those actually are things that also have to be addressed.
People like to talk about risk, and there's a passing reference to the risk that government climate regulations might pose in the chair's memo for this hearing. I recall that Milton Friedman said, quote, "The Great Depression, like most other periods of severe unemployment, was produced by government mismanagement rather than by inherent stability of the private economy," close quote. Isn't there a rather large risk that regulators will get it wrong on climate risk, like they did on mismanaging the money supply in the Great Depression? Should we... Go ahead.
I'm sorry. Absolutely. I do think that there is exactly that type of risk until we are armed with the information that will give us the degree of reliability that we have those risks understood. As all the risks that I just mentioned earlier, the financial risks, the non-financial risks that banks are on point to manage today in their day-to-day operations, there's a wealth of historical information from which they can draw upon to be able to make those assessments. I'll say that the one that they have the most difficulty with is the risk associated with operational risk, because we just don't have that type of data there. And so if we don't have that kind of data there, and we've been dealing with operational risk for many, many years, imagine the issues that we have associated with trying to get our arms around and quantify climate risk impacts from a physical and transition risk standpoint. That is extraordinarily difficult, and anybody who will tell you that the data exists for banks to be able to make very precise estimates and make hard money decisions on that, I'm just not a buyer on that.
Okay, thank you very much, Dr. Rossi. I see my time is about to expire, and so, Mr. Chairman, I yield back.
Thank you, Mr. Posey. I'd like to recognize another gentleman from Florida, Mr. Lawson, for 5 minutes. I think.
Can you hear me? Something happened to my computer.
Yeah, well, you disappeared. There you are.
Okay. Look here, I would just like to say to my colleague, Mr. Posey, is that we work so hard because of natural disasters in Florida on citizen establishing a government-run insurance program to make insurance available. And this is to everyone. The effects of climate change are seen year after year, strong and more frequently. Natural disasters are destroying homes and business at a record-breaking rates. In 2018, Hurricane Michael hit the Florida Panhandle, where I am, causing approximately $25 billion and damaging and devastating our local community. Only a few months after Michael hit, we saw property insurance rates increase, leaving some Florida homeowners unable to find affordable policy. What steps should Congress and insurers be taking to address these rising issues, because they come every time? And we have devastated in Florida after Andrew and even in Michael. and it just never going to stop. But we have to do something here in Congress and insurers across America to make things happen. This question is posed to everyone. What do you think we should be doing in Congress?
Well, if I could jump in, I think that there's two really important things going on here. One is that we're seeing in a systemic way these risks rising over time, as you pointed out. And the other is that we have many, many people, low-income folks, fixed-income folks, who are being really harshly punished by the financial consequences of these disasters. So in terms of insurance, we need to make sure that more people are carrying insurance in the first place. It needs to be more widely available, more affordable. But at the same time, we need to recognize that some of these risks over time are going to become inherently uninsurable in some of the highest risk places. So we have to create other pathways out of risk for people. There are so many, many people on the front lines of this risk in the state of Florida, for example. We have to create pathways out of risk because right now it's not just having financial consequences, but taking a real toll on people's lives and their well-being.
But a little bit of a follow-up. Many residents quickly found out, as you stated earlier, that the policy didn't cover the damage caused by rising water. Climate risk is not adequate price in the housing market. This rally found that current home prices, mortgage interest rates, and guaranteed fees in the secondary mortgage market did not make much sense either. There's a lot of concerns about rising the water playing a role in property values. So what should Congress, GSEs, and housing agencies be doing to address this concern?
Well, I think in the first place, it's really important to evaluate the risk clearly and communicate that risk to the public. Better flood risk maps that actually communicate this information to the public so that they can make informed decisions about what is likely to be their single biggest asset. Right now, we have large swaths of the public that are largely unaware of how serious these risks are and how quickly they're coming. The other piece of this is really building in an equity and justice component into our climate resilience policies, because we're seeing communities of color get gentrified out of their communities. We're seeing resilience investments that benefit an elite few and not the broader public. And that needs to change as we go forward because these risks are now affecting way too many parts of our country.
But look, Doctor, you also testified we can fix the climate crisis. Any other major social problem, which I'm not sure of, if we don't build justice and equity into our solution from the onset. Will you please elaborate a little bit more on that, and how can the whole government approach be undertaken by the Treasury Secretary Yellen and the NEC and others through the recent climate financial executives order inform our approach here?
I think we have to start with the fact that our current market outcomes are inherently got baked into them years of structural racism and socioeconomic inequities. We've had communities that haven't been able to build generational wealth because of the legacy of mortgage redlining and lack of access to credit, as just one example. And that means when you have climate risks coming on, they're coming on as a layer of additional risks over these long-standing problems. As we create solutions, let's not have band-aids on top of the current system. Let's actually be thinking about a fairer, more equitable system that keeps people safer, everybody, not just a few, but everybody.
With that,
Thank you,
Mr. Chair,
Dr.
I yield back.
Cletus. Thank you, Mr. Lawson. Gentleman yields back. We'll get through Mr. Barr's questioning, and then I think we can adjourn this panel. But I'd like to recognize the gentleman from Kentucky, Mr. Barr.
I thank my friend and the chairman of the subcommittee, and I appreciate the testimony of the witnesses. I know that fighting climate change is in vogue and everyone wants in on the action, but count me as someone who is a skeptic that increasing bank capital requirements or punishing lenders for not redlining energy companies is the way to go about it. My colleagues and also some folks in the administration clearly want to weaponize the blunt instrument of bank capital requirements to force a precipitous and unrealistic and I would argue uneconomic transition away from fossil energy. The problem is this will do nothing to change demand. People will still need to drive cars, turn on their lights, heat their homes. And the Biden administration's own data shows that fossil energy will still make up more than 70% of consumption in 2050. These efforts will just disrupt the supply side by shifting financing for those industries to less regulated non-bank lenders, drive up the cost of capital, and raise prices for consumers. Now, I know some of the witnesses want regulators to go beyond just banks and go into non-bank financing as well. But combine all of this with data aggregated by the Bank of International Settlements that shows that increases in capital requirements lead directly to reductions in lending. And it becomes clear that this effort is not about managing financial stress, but it's really about causing financial stress, specifically to those companies and industries that are politically unpopular. Dr. Rossi, what impact would the assessment of capital surcharges like those detailed in the draft Climate Crisis Financial Stability Act have on lending to fossil energy firms?
Well, you've hit on many of the points that I would make. I think the first one that I'd mention is that raising capital, first of all, will squeeze out lending in other segments, particularly in that segment. If you're talking about, as I've seen, 150% risk weight associated with oil and gas investments, as one of those proposed bills has in it, I would be concerned, first of all, as to where does that 150% risk weight actually come from? What is the empirical basis for which that comes from? Because if you can imagine what that means, we're talking about significant amount of capital being dedicated to investments in oil and gas, which have knock-on effects, as I mentioned earlier, in terms of lack of ability through lack of lending to be able to go out and do the kind of oil and gas exploration that's needed to keep us in being protected against having to go elsewhere abroad for our fuel needs.
I do think there's a risk here that by choking off financing to some of these energy companies that are really at the forefront of innovation in carbon capture and other technologies, that this could actually be very counterproductive. And it does look like an effort to exploit climate as an excuse to justify a move towards government central planning, as opposed to an effort to help deploy capital to innovative companies that actually might ameliorate emissions and decrease emissions. Let's talk about systemic risk for a second. There is an important distinction between systemic risk and business risk. Systemic risk has a very specific definition. A certain activity or entity has the potential to actually bring down the entire financial system without enhanced supervision. But business risks are the countless risks firms manage every day. If not mitigated properly, may have an impact on their bottom line. No one is denying the risk to changing weather patterns. And in fact, banks, insurers, and other financial firms are already managing them as traditional business risk. It is hyperbolic to suggest, as some of my colleagues and vocal advocates have, that climate change, a phenomenon that occurs over literally decades, can somehow suddenly and precipitously overwhelm the banking system, insurance sector, and reinsurance sector, especially when you consider that a lot of the stress testing happens only over 9 quarters. So, Dr. Rossi, how are banks currently managing climate risk, and are they capable of effectively managing it without prudential supervision?
I'm going to take you back, Congressman, to the earlier comment that I made about this with regard to Citigroup's climate disclosure. Now, again, I don't work at Citigroup any longer, but having looked at that just objectively, I'd say that that's a really good first step in the process. They have gone through and they have identified where their climate risk exposures are. They've identified the governance and the processes and controls that are necessary to manage climate risk, and they're doing it fairly comprehensively. And again, you're talking about a far-flung portfolio reaching out to many countries in terms of their investments. So I think they're on the right track, and I'm sure all the other big banks are on a similar path to do that.
My time has expired. If I could just, if the chairman would just indulge one final comment. We talk about transition risk. A lot of these bills that are being proposed by this hearing, I think, create the transition risk.
Gentleman's time has expired. I thank him for that one additional comment. I'd like to thank the witnesses. I think there is agreement here that there is some real risk in the financial system. And I think the question is, how long a horizon can we really analyze and determine? But there's no question that there's risk here. I think all the panelists would agree. And, I just appreciate the testimony. I'm sorry that it's been kind of a rushed afternoon. I want to thank you all for your testimony and devoting the time and resources to share your expertise with this subcommittee. Your testimony today will help advance the work of our subcommittee and the House. The chair notes some members may have additional questions for this panel, which they may wish to submit in writing. Without objection, the hearing record will remain open for 5 legislative days for members to submit written questions to those witnesses and to place their responses in the record. Also, without objection, members will have 5 legislative days to submit extraneous materials to the chair for inclusion in the record. I remind the members to submit written questions and materials for the record to the email address provided. This hearing is now adjourned, and I thank the witnesses. I'm going to come down and thank you personally. And to those of you on the screen, thank you very much. Your testimony was really appreciated. And again, we're on a very busy afternoon, so your time, we really appreciate you being here. Thank you.